The world really isn't in a good place at the moment. Pandemic cases are back on the rise, governments are putting more and more safety measures in place, and a second lockdown is looking ever more likely. But yet, prices in the housing market are still rising. Today I'm going to be going in depth and trying to explain why these prices are currently rising and analyse whether these price rises are temporary and likely to come crashing back down, or whether they're going to continue on the rise. As always guys, if you've got any questions about anything I say today, be sure to leave them in the comments down below and I'll try and answer them whenever possible. Now let's get into the video. So let's start by going over some of the recent housing market data. Both the HPI index, which is published by the UK Office for National Statistics, and the US FRED, which is the US Home Price Index, show an increase in property prices over the last few months. The UK has seen a whopping increase of 3.4% between June 19 and June 20, with an additional 1.8% rise in July alone, a massive 2% rise in August, and a marginal 0.2% rise in September so far. This data all comes from the UK Office for National Statistics, Nationwide and Rightmove, so fairly reputable sources. But also remember that these sources are probably likely to try and paint a better picture than what might have actually happened. In that same period between June 19 and June 20, the US saw an even bigger rise in the housing market of 4.3%, with a 2% increase in July and a similar increase in August as well, so an even bigger rise. Pandemic cases in the UK are back on the rise again, almost nearing all-time highs once more. Pandemic cases in the US, however, have kind of plateaued. So what gives? How can it be that home prices are still rising when the pandemic cases haven't gone away and, if anything, are rising back up once more? Well, firstly, a little bump in the housing market was almost guaranteed because everyone had pretty much been locked in their homes for months, which drove people absolutely crazy. The only times in history where people have been forced to stay in their homes and haven't really been able to go out would be the mass influenza case in 1918 and the Black Death of 1346 before that, so it's never really happened in anyone's lifetime. This obviously caused a lot of frustration and a lot of people wanted to move homes. A lot of other people also realised that they could actually do their job from home and could work from home, and therefore looked to upsize their properties to find one with a home office. Other people as well might have had a breakdown in a family relationship and therefore just needed a new home as well. So when the housing market was unfrozen a few months ago, it's no wonder there was a massive spike in sales volume and sales prices, because obviously people that wanted to move ASAP got into bidding wars and were willing to pay pretty much anything. On top of this, people that were scared of the pandemic and lived in densely populated areas like London or Manchester in the UK and New York or LA in the US potentially wanted to move somewhere a little more quiet. And if you add into this low interest rates and interest rate cuts, it basically gave people the perfect opportunity to remortgage or find somewhere new. Now I do also want to say though that a lot of banks did take some of their riskier products off the shelves, such as 5% deposit mortgages and 10% deposit mortgages. But a lot of properties that are being sold at the moment aren't small starter homes being sold to first-time buyers. No, Savills data shows that actually much bigger properties in wealthier parts of the country such as London are what's driving these price rises. So the fact that the banks took away these 5% and 10% deposit mortgages didn't have much of an impact, because these price rises are being driven by wealthier individuals and potentially external investors buying larger properties with smaller mortgages or maybe even cash. You also have stamp duty cuts. Now these cuts don't just benefit people buying properties for less than £500,000, because you now need to pay zero stamp duty on these properties, but they also provide savings to people buying properties over this value. In the past, if you wanted to buy a property for £600,000, you'd be paying around £20,000 in stamp duty, whereas now you're only paying about £5,000, so that's a big £15,000 saving. This little added benefit by the government drove people mad to buy up properties while they still could, because these stamp duty cuts are only temporary, which therefore further pushed up the prices in the housing market. Over in the US, the Fed, or the Federal Reserve, has been buying up mortgage-backed securities at a really fast rate. Now this is giving the banks confidence to continue lending to people because they know that at the end of the day, well, the Fed are probably going to buy those mortgages. Which is eerily similar to the scene from the film The Big Short, where the mortgage broker gets really cocky because he knows that if he writes a mortgage offer on a Friday afternoon, that a big bank will buy that mortgage by Monday lunch. But only this time it's not the big banks going out and buying those mortgages, it's the Fed. On top of this, pretty much all of the home builders in not only the US but the UK as well were shut during the lockdown period. This means that the number of completions and the number of new homes sold is down significantly, meaning that people will pretty much pay anything that they can to get their hands on a new home. All of this together has had a massive impact on the supply and demand equation. Demand for homes is up massively because of these stamp duty cuts, these low interest rates and the desire to move somewhere new. Whereas actually the supply of homes has decreased because obviously a lot of the house builders have been shut, and because of the government measures put in place such as mortgage holidays and furlough, people actually haven't lost their homes just yet. This unfortunately has created almost this perfect situation for people to put their homes on the market to escape their current situation and buy somewhere new for a vastly overinflated sum because of these stamp duty cuts and the promise of low interest rate mortgages. If you're enjoying the video so far, be sure to drop a like down below and subscribe to the channel if you haven't already. If you enjoy my channel and the content that I make, then also feel free to click the join button down below as well and support the channel so I can continue making content just like this. Now on to the question that everybody wants answering. Are these price rises going to continue, or are they all going to come crashing back down? And if so, when's the crash going to happen, and how much are these properties going to crash by? Well, I've gone a bit more in depth on the recent data in the housing market on my most recent video of the housing market just here. But today in this video I'm basically going to explain how the housing market is going to crash and to go through some additional data and recent developments. Well, firstly, a lot of these government schemes that have been encouraging sales are soon going to end. Furlough is set to end at the end of October, and it's currently unknown whether a second stimulus check will be received in the US. Mortgage holidays or mortgage forbearance in the US and the UK is also set to end at the end of October, but with potential extensions available. The stamp duty cuts in the UK aren't set to end until March, but obviously if the population is made redundant before then, well, people won't have any money or any salary to buy a property with. Now the big problem is that people are getting really comfortable with having these government schemes and other schemes like the Eat Out to Help Out scheme in place. People have been saving loads and loads of money because they haven't been having to pay out for their mortgages, and they've been paying a lot less on food, and probably also haven't been spending much money on petrol because they haven't been going to their place of work. So obviously their spending could be set to increase massively. Now this is a really big problem because a lot of people that have been making these savings have increased their spending in other areas of their life. Maybe they've been taking more holidays or eating out more or getting more takeaways. So obviously when these schemes do end and their spending increases massively, they're going to have a real shock to the system because they'd already increased their spending to start with, and now it's going to push it over the edge. People are going to have to start paying their mortgage again. People are going to have to start spending money on gas or petrol again. People are going to be spending more money on food and buying all those takeaways still. And people are going to be spending money on those additional holidays, all while facing potential unemployment and therefore foreclosure and eviction. In the UK, new measures have been introduced such as 10 PM curfews on restaurants and pubs and limits on groups of up to a maximum of 6 people in an effort to try and curb the spread of this pandemic, because in the UK these pandemic cases are definitely on the rise again. Therefore, it's looking more and more likely that there could be a second lockdown, and this would be really problematic to the economy because it's firstly unlikely that the UK government and the US would provide the same support that it had done previously. Therefore, there would be even bigger unemployment than there was at the start of this year, meaning a lot of people are going to lose their homes and a lot of homes are going to flood onto the market, causing a housing market crash. If you've made it this far into the video, then be sure to drop a comment down below saying the words market crash, so that I know that you've made it this far into the video. So therefore, I think that in the short term, while we currently aren't in a second lockdown, that the prices are going to continue rising because obviously the stamp duty cuts are still there, these low interest rates are still there, and so are the other benefits such as those mortgage holidays. And I think on top of this, people are going to continue rushing to try and find a new home as fast as they can and pay literally anything they can for it, because I think the population kind of know that a second lockdown is looking more and more likely. But I think that in the medium term, it's looking more and more likely that we're going to go back into a second lockdown. Obviously, the furlough scheme is set to expire soon, and therefore unemployment is going to rise massively. And a lot of people are going to lose their homes because they won't be able to keep up with their repayments. I also think it's very unlikely that the UK government would spend hundreds and hundreds of billions again, and also unlikely that the US would spend trillions and trillions to support businesses and to issue more stimulus checks. I also think it's just as unlikely that banks would ever waive mortgages for a while, and therefore I do think a lot of people are going to be losing their homes to foreclosure and eviction. Basically, I think that these price rises are temporary, and it's looking ever more likely that there's going to be a really big crash. But there's a lot of data out there at the moment on just how far these prices will crash. The Centre for Economics and Business Research warns of about a 13% crash in the market, although some of the estate agents like Knight Frank and Savills warn of a smaller crash, say 7% or 7.5%. I think it's also important to remember though that estate agents are obviously going to try and play down the effects of a housing market crash, because obviously they want to try and sell as many properties as they can and basically claim their commission. More pessimistic forecasts from the Bank of England and from Jefferies, the boutique investment bank, warn of bigger crashes such as 16% or 20%. I imagine that the bigger crashes will be seen in busy cities such as London and Manchester as people move further afield as a result of the pandemic. Prices could actually rise in smaller cities due to flooding and overpopulation from these bigger cities. I also think that flats are more likely to crash more than houses because obviously people aren't going to want to live in very close situations because of the pandemic. And as always guys, if you enjoyed this video, be sure to check out some of my other videos. Alternatively, subscribe to the channel and ding the notification bell, because that way you'll be alerted when I upload a new video. Cheers!